Hey guys, hope you're doing well. Welcome back to another webinar. You guys are probably very used to this with all the different guests and things that Eightcap have had on over the past several months. But if you're just tuning in, if this is your first webinar with me, my name is Nick Syiek. I am a Forex trader on YouTube. I own a business that builds tools for traders, and I'm honored to be here with you guys. Eightcap has asked me to be this month's guest, and I'm super happy to be here. Today, I have a couple things for you that I think are going to be hopefully really helpful to you. In these last couple webinars with you guys during this month, my goal is to hopefully impart with you some really helpful things that you can take away with your trading. Now, of course, I do want to just do a little bit of a follow-up with our weekly stuff for just a minute or a few minutes here. We'll discuss the stuff that we've been talking about if you've been a regular tuning in to the webinars. And then I have a lesson on risk management that I hope that you'll stick around to the very end for. I think it'll be very helpful to you. And again, it is something that if you stick around to the end of that presentation, I'm going to be showing you guys some of the secrets, if you will, the quote unquote secrets that really, truly, genuinely helped me start actually making progress in my trading and really helped me get to profitability. So stay tuned to that. The first thing I'd like to just go with you guys here is we'll direct our attention to the dollar here for a moment. And if you guys remember, we were looking for dollar longs, and we actually ended up getting exactly what we were looking for. So what we're currently looking at is dollar Swiss. Now, we put out a tweet, Eightcap actually put out a tweet asking which charts you guys were most interested in, and we got some, so between the two, euro dollar and dollar Swiss, were sort of our top interested currency pairs. Now, dollar Swiss, if you guys remember, we discussed being long biased on the dollar against the Swiss franc on a retest of this area. So from purely a technical standpoint, we have we've hit it right on the mark here. And of course, I wish every trade was that easy, but we really, truly, in this case, we did. We caught the buy in this zone. If you guys were watching, then you'll know that this was exactly what I was looking for, was a opportunity to get long the dollar against the Swiss franc. And we have started to see that. Now, just a little follow-up for those of you guys who may be watching the dollar Swiss yourself or the euro dollar, just generally speaking, if you're dollar bullish, I think we're headed to the previous high, and watching for that retest of the highs will be very interesting. Now, for me, what I like to do is I like to trail stops. So I have not yet moved my stop loss, but on any sort of retest of the high, once we get up there, my goal is to look for an opportunity to trail stops into profit. So if you're in the dollar move with me, then congratulations. That's an update on my thought process. We can narrow down just a little bit more on the 1 hour chart, and I'll show you guys what I'm thinking. So there's our zone. We caught that buy in that area. Price has been pushing to the upside, and my goal is to at the very least, take my risk off the table. My stop loss is down in this area. My entry is in this area. I'd like to take my stop loss and at the very least move it to break even, but really I'd like to try and see if I can lock it just behind market structure here to see if we can let this thing continue to run past the highs. That's my personal opinion on the dollar. I just wanted to make sure I followed up with you guys who are interested in that conversation we've been having, and we'll go from there. Now, I just want to pause here for a second and just say hello to some of the people that are in the chat. Hi to Antonio, Bale, Eamon, Emidio, Johannes, Lewis, Michael, Nick. I'm going to call you Olu because I don't want to mess up your name too bad. Rajneel, thank you for being here. Sadarshan and Winey. Win, I'm not sure if I said your name correctly. Either ways, I apologize if I mispronounced anybody's name. Thank you for being here. And if you have any questions, feel free to ask them. And I'd also be curious, where are you guys from? Let me know in the chat. We have the chat pulled up. If you drop a message in the webinar chat there, I'll be able to see it. So thank you guys all for being here. So, okay, I mentioned that I have a session that I'd like to go through with you guys in terms of risk management. I'm really, really excited about that. So the last thing I want to talk about is just make sure I follow up on my euro dollar idea, which we discussed. If you guys were here, we discussed the 61.8% retracement. Now, what I'm talking about specifically is we drew from the swing high to the swing low, and we looked for that 61.8 to get tagged. Check this out. We got right up into that zone, held it, and have since made a nice push to the downside. So, you know, we're not in the clear per se. This thing could still find a higher low, but for me, what I'm looking for is the higher time frame trend, the daily chart, to continue trending lower. I like this thing bearish, and I think that we've got a nice start off the 61.8%. We'll see if this thing can continue to rally back down to targets, which would be, in my opinion, you got a good chance of seeing 96.60 and perhaps even the retest of the lows around 95.50. So there you go. That's my thought process there on the euro dollar for those of you who have been keeping tabs on that with me. All right, so I do want to turn my focus here to the presentation that I put together for you guys. So here's the thing, right? Like I said, I'm a guest here this month. This is you guys' turf. I'm in your terrain, and I'm hopefully going to add some value to your trading. I mean, that's what Eightcap has brought me here to do, is to offer some value to you guys as a community. And I just want to say, just pause for a second. The fact that Eightcap does that for its clients is incredible. It's really, really cool, and not a lot of brokers invest that sort of thing into bringing on analysts and guests that could really take them to that next level. It shows a lot of integrity to the broker, and I appreciate it. I think you guys should as well. So anyways, risk management. Here's the thing. Everything changed for me when I really started paying attention to risk management. And I know that sounds kind of cliche, but I'm telling you, it's not just cliche, it's kind of in the math. Because risk management is going to be the only thing that is looking out on your account when losing streaks inevitably come. I don't care how long you've been trading. I have losing streaks. I've been trading for 5.5, 6 years now. I've been profitable for about 3.5. And I can tell you, through both when I was a losing trader and when I was a winning trader, the losing streaks didn't stop. The only thing that truly genuinely changed on the losing streaks was how extreme and intense they were based on my risk management principles. So let's dive in. I want to talk to you guys about risk management and why it is so important. So there's a common phrase in the poker world. I'm not sure if you guys have ever played poker. I am by no means a pro poker player or blackjack player or any of that. I'm not a pro in that area. I understand the basic principles and how it is comparable to trading, where it is a game to a degree of chance and probabilities, similar to trading, right? There's no guarantee that the market's going to do anything, right? It's all to a level of, to a degree, there is a level of randomness, there's a level of chance, there's a level of possible outcomes, okay? So the common phrase, know when to hold them and know when to fold them in poker, is similar to knowing when to hold on to a trade and knowing when to cut a trade when it's no longer showing any validity, okay? And we can talk about that more as we get along, but here's the thing. You need to accept something if you're going to be profitable. If you're going to do this for 20 years, you're going to have some terrible losing streaks. You're going to have some drawdowns. You're going to have some pains. It's just the numbers. Think about it. If you have 60-40% win rate on a one-to-one strategy, you do that for a long time. That's incredible. That's a really, really good stat. If you can achieve that over the long term, you're a really phenomenal trader. Doesn't sound too exciting, but really with 60-40 odds, you would be able to make tremendous amounts of wealth from the markets over time. Okay, well, here's the thing. Even with a 40% loss rate, you might say, oh, that's the minority. It won't happen too often. Even with that, in a series of 1,000 trades, you're gonna have several instances where you have 10 trades that are losers in a row, even on 40% odds, right? It's just the math, okay? So if we accept that going forward, it's gonna be important that we do. We need to talk about how we manage that situation. So we've heard that term, but what does it really truly mean? Well, it means that we need to minimize the potential losses we could incur while at the same time maximizing our potential gains, right? Knowing when to hold them, knowing when to fold them, knowing when to hold on to trades, knowing when to close trades, manage your risk, keep your position small, and all of that is so important. So let me ask you guys a question. I'd be curious. Have you ever held on to a losing trade without a plan of getting out of that trade? And I know the answer for many of you, as well as myself, I have, with no plan of how to get out of the trade, right? So you enter a trade, there's a rush of emotion, you feel strongly that gold is going to go up, and you buy gold. And the market starts going down, and you're sitting there and you're saying, what the heck? Why is gold going down? Everything told me, my technical analysis, my fundamental analysis, everything told me that it would go up. and it didn't go up, right? In the end, it continued to go down and down and down. And if you've been like me in the past, I had no plan to get out of that losing position except for hoping that the market would reverse. That right there, you guys, that long term is basically a surefire way to end up broke trading Forex. You have to have, when you take a trade, a plan in place to get you from the start to the finish of that trade. If you don't have that, you are basically leaving it to chance completely and basically gambling. So we don't want to do that, right? We don't want to just gamble without an edge. We want to have some sort of probability over time that we're going to do well. So a couple different ways that we can manage risk. There's more than one. So believe it or not, it's not just put a stop loss in your trade. Yes, that is important, but there's more to it. A stop loss allows us to set our risk by closing out of our positions if the trade goes against us, okay? So in the picture that you're seeing here, hopefully you can see that completely. The buy trade is entered, and sure enough, the market, which was in a nice uptrend, completely falls apart and starts trending the other direction. A stop loss in this case allows us to get out of that trade and hopefully do so without taking tremendous amounts of damage to the account, right? So we take a buy trade and the market decides to reverse and trend lower. We could limit our downside risk by stopping out when we admit that we are wrong on the trade. Now, there are many ways that you can choose to set stop losses. In fact, you could go into a whole documentary series about how to place stop losses, because you could place stop losses based on average true ranges. You could place stop losses based on moving average reversal triggers. You could put stop losses based on a time constraint. I know a trader that loves to basically, he doesn't use a strict take profit, a strict stop loss, but what he does instead is he says, if this trade is not in my favor in 10 days, I will stop out of the trade completely, no matter where it's at, right? If it's in the negative, I'll stop out, right? So that's an interesting concept as well. So you have all these different ideas on placing a stop loss. So that doesn't get us the full answer by itself. It tells us one idea. One idea is to consider, I want to get out of a losing trade by placing a stop loss. Personally, what I like to do is I like to use market structure to help me place a stop loss. So for example, maybe I'm in a long trade and there's a major level of support below my entry. If price breaks out to the downside on that support zone, that's probably a cue for me to go ahead and get out of my trade. That's how I would handle that, right? So we've been discussing that a lot this month with the dollar concepts, but that's where I'm headed with that. Is you can use stop losses how you'd like. Some people use, like I said, average true range, reversal indicators that will tell them, okay, the market is reversed, go ahead and stop out, etc. Right? Many options there, and I would encourage you guys to do some back testing with each one. There's at least in my experience, there's more than one way to stop out of trades. The idea is simple. You're stopping out of something that is not going in your favor as quickly as you reasonably can. Question becomes, though, where do you put a stop loss? Is it so that it's not as likely to get hit, right? Because so many traders, they're super frustrated by stop losses because they place one and the market goes down and taps their stop loss on their buy trade and then heads back the other way. So there's no perfect answer here. Again, remember, we mentioned losing streaks, all that stuff. You play this game long enough, you will incur and experience drawdowns and losing streaks. It's just guaranteed. So how much risk should you put on a stop loss? That's another common question. Should you risk 1%, 5%, 0.5%, 1/4%, 1/10%? What is the proper amount of risk per stop loss? This is sort of going to be dependent on you, but because again, it's going to come down to your tolerance. Are you a more risky trader? Are you willing to take higher risk? Okay, maybe you risk more. If you're not, maybe you risk less. First, we need to know that percentage is what matters. When it comes to a stop loss, we have to think about percent, right? So how much percent of your account are you comfortable risking if the trade goes against you? You should probably ask yourself this question on every trade you place. Think about it. Before you place a trade, I hope that maybe one of you guys is writing notes down or something, but this would help you. Before you place a trade, the first thing you should ask yourself is, what am I going to do if I'm wrong? So many traders, guys, I've been on YouTube. I've worked with thousands of traders. Ego is the brutalizer, for lack of a better term, of trading accounts. Ego kills traders in their trading career. Like it kills the chance of them being profitable, because we all want to be right all the time. We want to be right. We refuse to be wrong. And many traders never, the thought process to ask themselves, what if I'm going to do if I'm wrong, doesn't even cross their mind. They're so sold, they're so overly confident, they're so egotistical in their trading that they don't even fathom that they could be just completely wrong, right? You have to ask yourself before you place a trade, my opinion, what am I going to do if I'm wrong? Like, just lower that ego, lower that level of confidence, because it'll get you in trouble in trading. It's just not worth doing. So you say to yourself, what am I going to do if I'm wrong? So then the question is, how much do you risk per trade? I have a varying amount of risk that I'll do per trade. If I'm more confident, I might risk slightly more, but usually I'm never risking more than something like 3% per trade. That's very, very high though, and very extreme even for me. Like usually an average area is 0.5% to 1% on a particular trade for me. I don't like to risk a lot per trade. I think that is a dangerous game. And when you look at the math and you spend time backtesting, you'll see that even with a 3% every trade risk per trade, it's very easy to get yourself in some nasty, nasty drawdowns. Because what if you have 10 losing trades in a row on 3%, you're at 30%, give or take. The math doesn't quite line up like that, but it's approximately 25 to 30% down in just 10 trades. And trust me, 10 losing trades in a row sounds weird, but it's possible even for the best of traders. So if I had $1,000 in an account, personally, I'd be risking probably 1% per trade, which comes out to about $10. And this is just my opinion. If I'm trading on a $1,000 account, 1%, it's not a perfect holy grail number, because you can still get yourself in some nasty drawdowns even with just 1%. This is trading after all, and sometimes you just get some very unfortunate losing streaks despite sticking to your trade, sticking to your plan. So again, a lot of traders, they say, well, Nick, I've got $100 in an account. I don't want to risk 1%. That's going to get me nowhere. And again, trading is an unfortunate truth. There's some unfortunate truths to trading that I think a lot of people don't like to hear. They don't like to hear that trading, like most businesses, takes money to make money. And maybe you could go the prop firm route. That's another conversation for another day. Perhaps that could help you boost your capital levels if you have the skills to do that. But I'm speaking just now in context to small accounts. Trying to sort of build up a small account really quickly is a very, very tough game to play. And if we're going to stick to proper risk management, which I truly, truly believe in, if we're going to be responsible risk managers, we have to account for the bad times in trading. It sounds pessimistic, but it's just important. They're not the fun thing to talk about, but they're the important thing to talk about. Losing streaks are going to happen. If you have 10 losses in a row, can your account handle that? And you should probably think about that. If you're sitting there and you're risking 10% per trade on a $100 account, you're risking 10 bucks, and okay, 10 losses are going to happen at some point, even to the best of traders. That would blow your account, right? If you're risking 10% per trade, you're going to blow your account basically. And so that's not a feasible option, right? So we have to think about, okay, well, if that's going to blow our account, we can expect that to happen at some point. We have to be accounting for that. So if you were to risk $100 per trade on a $1,000 account, we'll run through this exercise. Two trades gets you roughly, and again, this is approximately, roughly a 20% drawdown. 5 losses, just 5 losses, takes your account down by half. And I'm sure many of you guys have seen that chart where if you lose 50% on your account, if your account goes down by 50%, in order to get back to the full amount, you need 100% gains. And the math, to keep it simple, you have $1,000, it goes down to $500, right? If you have $500 and you need to make $500 in order to get back to 1,000, 500 over 500 is 100%, right? You need 100% gains, even though you just had a 50% drawdown. The math is unkind to traders who get into sticky drawdown situations. So risking small will, in most cases, keep us out of those desperate situations. So 10 losses is going to blow the account. 5 losses is going to get you roughly a 50% drawdown. And so that's the thing we need to account for. Losing streaks happen to every trader, even the fake ones that you guys see on social media, right? The ones that are only ever showing you the Lambos and the cars and the all blue profits on their screen like that's their everyday situation. It's not. Trust me, I've been in this game a long time. I know people can fake profits. There's so much to this stuff, right? That I'm hoping that my experience in this can hopefully rub off on you in the right way and help you out a little bit with sort of spotting things that you need to be careful about. Okay, so position sizing. Now again, you have to kind of come up with what your risk tolerance is. Are you going to go for 0.5%? Are you going to go for 1% per trade? Figure that out. The only way to figure that one out is to back test. Go use your strategy and see, if I took 1,000 trades or 100 trades with this risk management method, what was my worst drawdown? How much did I on average make or lose on a trade? Those stats are things that you should have on your own trading before getting into the markets. Anyways, how do we know what position size to use? This is a common question. What lot size do I use, right? It's going to depend on the asset that you're using. And oftentimes the best way I would say for newer traders is to go find a lot size calculator on the internet. Babypips.com has a free lot size calculator that can be very useful. So what you do is you just plug in which asset you're trading, how much you want to risk per trade, whether it's percentage or part of your account balance, and you can get a calculation to give you lot sizes. Oftentimes traders make this mistake where they put on too big of a lot size, not realizing that asset A trades differently than asset B, right? If you're placing a one lot trade on the euro dollar, that's going to be very different than placing one lot trade on the gold market, right? Very different assets, and the movements of those assets can get you into a lot of trouble if you're using the wrong lot size on them. So I encourage you, go find a lot size calculator. There's plenty of them on the internet, but Baby Pips has one on their website that's pretty good. Okay, another level to this risk management conversation we're having is max drawdowns. Okay, we have to, just to get dark again for you, when developing a trading strategy, it is important to account for the worst case scenarios. Okay, we want to be prepared so that if it springs upon us, we have some level of competency to deal with it. So every trading strategy involves losing streaks or drawdowns. But when do we know how to actually stop using a trading strategy? I get this question on my channel personally very often. I have a YouTube channel. It's Trader Nick on YouTube if you'd like to find me after the webinar ends. A common question I get is, Nick, my strategy doesn't seem to be working. How long should I stick to it? Because remember, we talked about this earlier. We talked about how, okay, well, even a good strategy is going to have losing streaks, but it's very numbing. It's very scary, actually, when you're trading a strategy and it starts going through a losing streak in real time. It's like, oh my gosh, is what I'm doing working or not, right? Very common concern by traders is what I'm doing actually working or not? And there's some answers that we could go through, but every trading strategy involves losing streaks. So a max drawdown allows us to objectively state when something is not working anymore in our strategy, okay? This is gonna be the pull the plug, if you will, on the strategy. It allows us to pause a strategy and reevaluate, okay? So there's some answers to this. And the biggest one is going to be back testing, right? If you back test your strategy thoroughly, you'll have an idea of the performance of that strategy, the max drawdowns that you should probably expect. And oftentimes traders jump from a strategy to a strategy to a strategy. They just keep jumping from strategies saying that, oh, this one worked perfectly, that one was terrible, not going to do that one anymore, right? They keep doing this when oftentimes the strategy they were working with was fine. They just didn't have the tolerance to endure a losing streak on that one, right? So anyways, this is an unrealistic and losing approach to trading because everything is flawed. There's nothing perfect in this industry. That's why not everybody does trading, right? If trading was perfect for people, everybody would be doing it, right? So the question is, when is it time to pull the plug? Well, this is going to be up to a trader's risk tolerance and the back tested results of a strategy. In your back tests, let's say you normally see drawdowns of about 15% historically. That's like an average drawdown for your trading. A reasonable drawdown, max drawdown, sorry, might be to say, well, hey, if it gets to 25%, that's breaking the norm of what I would expect historically. And if we start getting, you have a 15% average, it gets to 20, you say, okay, well, this is extreme, but I got to stick to it. It gets to 23% drawdown, you say, I still got to stick to it. It's still within the realm of, maybe a standard deviation of the average historical drawdown that your strategy experiences, okay? But maybe you pull the plug at 25% because that's one that has not been seen yet on the overall back test that you've seen in your extensive studies of your strategy. And again, we're getting deep into this stuff. If you are serious about trading, this is the stuff that matters, is understanding through many hours of back testing your models and your strategies, average drawdowns are an important stat to know, and max drawdowns are something that you could set just outside of the standard deviations of a historical drawdown rate, right? So maybe on average you see 15%. But what if you normally, if you're maybe a little bit more aggressive and you're saying, well, I've see the occasional 25% drawdown on my account or on my back tested results. Perhaps a reasonable max drawdown, maybe 35 to 40%, okay? This is where you're going to have to do the work. You're going to have to spend time back testing. And again, everybody would like for someone to just hand them a strategy that says, look, it wins 90% of the time on a 2-to-1 risk to reward ratio. But when you spend enough back testing, you'll realize that is a fool's game to try and chase something like that. It is near impossible to find a strategy like that. So instead, it's better to accept, in my opinion, a reasonably good strategy that you accept the flaws with, and you say, hey, at this point, I'm going to pull the plug on a trading strategy that I have, and I'm going to reevaluate, okay? So what happens if I over leverage? This is a common mistake, man. This is so common with new traders. They get themselves into a lot of trouble by placing one bet that was way too big. And if you take a big position with no stop loss, drawdowns could absolutely blow your account. Anytime you take a trade with no stop loss, you are essentially, if you have no plan to get out of the trade prior to anything else, you're essentially risking 100% of the account. If you take a position, a big position with a stop loss, it could still seriously damage your trading account with multiple trades. Because again, you could have huge positions and still put a stop loss and say, well, look, I had a stop loss, but those stop losses are 10% of your account each. That's not a great solution either. So my opinion, possibly the best defense in our arsenal as traders for basically protecting our account, risk management, is to drastically reduce the size of your trading positions. My opinion is the fastest way to reduce your drawdowns and all that is to reduce your position sizes. There's an individual on YouTube that I watched for several years. He has since seemingly retired, at least for now. His name is Rob Booker. And what he said is that many traders try and focus so hard on just making a bunch of money quickly, but what a practical approach is, see if you can start averaging $1 profit per day that you trade. And if you can do that, maybe over time you scale it up and you size it up to $10 a day, or maybe someday $100 a day. Many traders try and start at the $100 a day, realizing very quickly that that is a difficult task to accomplish without a good sized trading account. But if you learn to make $1 a day on average, if you can prove to yourself, hey, I can do that, I can make $1 a day on average, then you're probably heading the right direction. The quickest way to improve as a trader, in my opinion, is to reduce your position size and experience a little bit more of the market moves. Earn your stripes, right, as a trader by position sizing smaller so that your damage to your account is going to be limited. If you accept humbly that you're going to need to take time to learn this stuff and there's going to be experiencing losses, and you just take that position size and shrink it down as little as you're comfortable doing, you're going to learn a lot more for a lot less cost to your tuition, if you will, to trading. So let's recap a couple things. Position sizing, keeping it small. managing your risk by placing smaller stop loss amounts, right? Percentage on your account, something that you're going to have to do. And maybe possibly my favorite point that we made was really spending the time back testing to see what your stats really look like. If you don't know what your stats are as a trader through your strategy, whatever you're using to approach the market, if you don't know how to have some stats, you should have some stats. And maybe maybe next time we'll do a mix of back testing examples. Maybe that might be a nice concept to work through together, how to back test strategies. So I would encourage you guys to join me next week. We'll be doing this webinar series again. It was good to see everybody in here. I see we have a number of people that stuck around. So thank you for staying to the end. All of you guys who were here with me at the beginning and have sticked to the end, I really appreciate it. And I hope genuinely that this was helpful to you. I would encourage you guys, if you're not already following me on YouTube, you can find me there. It's Trader Nick on YouTube. That is my channel. I've been on there for, I guess, 3 years now or so, give or take, sort of documenting my journey. I take live trades and I talk through my strategies and stuff like that. So if that would be helpful to you, make sure to follow me there. And again, I hope genuinely that you got something out of today's session. This has been really fun for me. I always love talking about this stuff, and hope to speak with and meet more of you guys soon. Thank you guys very much for tuning in, and we will see you back next week for our next webinar, hopefully on backtesting. See you guys later.